This meeting is being recorded.
Good afternoon, everyone. I want to thank you for joining us for the July webinar. My name is Julia Van Buren, and I am the Education Trustee for the SILA Foundation, and I want to welcome all of you today. We are very delighted that we have a very special team who is going to be going over surplus lines, and they're leaders in the surplus lines industry. First, we have Dan Marr, who many of you already know. He is the Executive Director and COO of Alani. Prior to joining Alani, Dan served as Senior Vice President and General Counsel for Lancer Insurance Company, where he was responsible, among other things, the analysis of insurance policy coverage and commercial and insurance litigation. He also served as General Counsel and Secretary for the DMT Financial Group and was a litigation associate for Green Hills Fire and Therm. I think that's how you pronounce it. Dan is an attorney licensed to practice in the states of New Jersey and New York and a number of federal courts. And he holds an ASLI designation and is a member of the American Bar Association. We also have John Meeks, who is Senior State Relations Manager for the WSIA. Before joining the WSIA, John worked with the American Academy of Actuaries, where he served as the Government Affairs Liaison to the Kansas Insurance Commissioner, Sandy Prager. John holds a degree in political science and a master's degree in government. We also have David Ocasic, who many of you also know, who is the Chief Executive Officer of the Surplus Lines Association of Illinois. He is responsible for the development and implementation of the overall strategic goals of the association with a focus on technology, education, and regulatory affairs. A former Yale University attendee, Mr. Ocasic is a native of the Chicago area where he lives with his wife and his children. We also have with us today, who many of you know, is Stefan. He will also be moderating today. Steve's background includes working as a regulatory counsel specializing in insurance compliance consulting, and he was the Director of Government Relations for NAPSLO. Steve's credentials also include earning his JD in Industry CPCU, ASLI, ARE, and MCM designations. I want to remind everybody today that we are recording this webinar. So put all your questions in the chat, and if time allows, we will answer all questions. Any unanswered questions will be addressed via email after the webinar. And the webinar will be available on the Foundation Library next week. And along with a recording, you also have access to the PowerPoint slides. And with that, I think that's everything. So I'm going to pass it over to our moderator for the day, Stefan.
Thank you. Welcome. I'm Stefan. I'm the moderator. We have a terrific panel, as she mentioned. We're going to talk about staying on the right side of compliance. The suggestion was we made that we talk about surplus lines and compliance, and you really can't do that unless you also talk about surplus lines tax. In the hour that we have, we couldn't have gone into too much detail about surplus lines tax because it's just too complex. There's too much information. One state's manual is 190 pages. That's just the filing manual. So the differences from state to state are significant. And all we can do is talk about resources. We can talk about options. We can talk about strategies. We can talk about common problems, but we can't get into too much detail on the states. So as she mentioned, I'm an attorney and I've been around these problems for a long time. So I work for an surplus lines company, trade association, a large broker. I currently work with CBIZ, is a broker that writes surplus lines, and I do some work for Encipher. Encipher is a surplus lines tax and compliance software and service company. First slide, Mr. Ocasic. What causes errors in tax filings? And so I know if I really could just download a simple answer to that, then I would be, we'd be rich. But it's the kind of things you would talk about. So first off, surplus lines is the broker pays the tax, and it's different because they have to get a declination. If the admitted carriers won't take the risk, the surplus lines broker has to file an affidavit. They have to make a record that they couldn't place it admitted. Admitted is a licensed company. They'll file forms and rates. They typically have a lot of data. And so the admitted markets work different than the surplus lines markets. What causes tax filing calculation errors? Well, human error, typos, stress over annual reports. In the first quarter of the year, the brokers have to file an annual report on the prior year. So the amount of data, the amount of work just becomes more difficult. That first part of the quarter is stressful for the filers. Turnover, differences from state to state, like I said, you can't overstate how difficult that is to come to grips. A large broker might have people working on a state, or they might, if it's big, they'll have several people working on one state. If you're smaller, the brokers might have to do 25 states, 50 states, and it's just difficult to come to grips with that many nuances from state to state. Confusion over the terminology. When you're filing, if you see broker fee on a document, you kind of know that the broker charged that fee, and then you can figure out if it's taxable if the broker charged it, because the states are all different. A policy fee, I don't know who charged that fee. It's not really descriptive. It might have been the broker, it might have been the carrier. Some regulators call their charges a fee. So difficult to know. So the bottom line for the team is, if you can get your company to use consistent terminology, it's easier to file. If you see service fee, again, you don't know whether that's something charged by your brokerage or someone else, and some of the regulators call their fee a service fee. So if all you see is a service fee on the declaration, the documents, you're going to have to go ask and try to get them to use better terminology. Inspection fee is charged by a carrier, charged by, when they write a property policy, they go out and do an inspection, they get a report on the property. Some states it's taxable, some states it's not taxable. Even the most basic kind of elements here are not consistent from state to state. So premium in one state does not mean premium in the next state. Sometimes it includes inspections and all these things. Master policy, probably easier to give you an example. So if a company might issue a master policy to Pizza Hut, and then it says all your franchisees are covered, and then they issue a certificate to the franchisee. So if you see that kind of structure, you're going to have to go figure out, how does the state want to tax these? And they don't treat it the same, and it might depend on where the money came from. So you have to go dig into the transaction. RPG is a risk purchasing group. It's authorized under federal law. It has to be an entity created and filed with all the states. Most of the state systems ask, is this an RPG? And it's kind of unusual, but still you have to answer that question when you're filing. Inland marine, again, it's the definitions, you have to, do a lot to educate yourself about insurance, but a bridge is inland marine insurance. And so if you're trying to figure out what coverage code to put that in when you're on the state systems, bridge sound like it could have been property, but you have to go dig into these definitions and try to figure it out. Fire premium is, the portion of the premium attributable to a fire risk, and a property policy covers things other than fire. So a lot of times the fire premium is, just a portion. So you have to figure out how to calculate the fire premium in a particular state in order to record the fire premium or the fire tax. There's a lot of complex calculations. There are states that still require allocation. So there was a time that the states were attempting to allocate tax. So if the risk had exposures in more than one state, they were going to allocate that tax out to the exposure states. And they've stopped doing that. They've stopped trying to allocate it, but the states are still requiring these allocation information when you file the taxes. Fire tax we talked about. Rounding requirements, I'm going to talk about making a manual for your company here in a minute, but the states don't round the same. And so when you make a manual, you just need a lot of detail in order to say this state rounds in this way. Some of them it's automated, so when you put the information in, it tells you how to round, but not all of them. And like I say, they do not round the same. TRIA is terrorism premium, and states differ on how you go about allocating that terrorism premium. In some, it's property, so you might pay a property tax on it. In some, it's allocated out on a package policy, those types of things. Laws change, confusion over the tax exemption. A lot of times, for the most part, a U.S. tax exempt does not mean that it's surplus lines tax exempt. That tax is on the broker, tax on the international exposures. The issue is if it's taxable, if it's in a state and then portion of it's out of the country, do you also collect the tax on the portions out of the country? You have to go dig into the particular state. Numerous agency management systems just makes it more difficult for the brokers. It's if you had one system and you could just get the information and put it in state's format, that is more functional than having 4 or 5 systems that don't record the information consistently. They don't have consistent data elements. The other tax and fees just make it more difficult. So one state has a local government premium tax. It's where the cities and the counties tax, and it's complex and labor intensive. There's a lot of regulatory surcharges. There's windstorm surcharges. There's a medical malpractice fund in some states. Fire tax is different. A marine tax in some states. But unfortunately, the real point is you have to have a different forms, different instructions for all these different taxes. So it is next slide, Mr. Ocasic. Thank you. How to avoid errors? Well, you're going to have to study the instructions, take all the tutorials that they have, and it's going to be time consuming. I don't think there's an easy way to come to grips with this. If you have one state, maybe, but if you have 25 or 50, it's going to be a big project. Automation reduces the human errors. There is the state systems help because when you log in and put your information in, it gives you it tells you whether your tax is right or wrong. Encipher has software. You can programmatically file in a lot of states. If you're a big enough broker to have IT resources, you can programmatically file, and that reduces the errors. But eventually, you're either going to have software or a detailed filing manual, state pages. You're going to have some mechanism to record all this information. The SILA and WSI surveys are great, but it's just very difficult to get enough detail out of those, because when you log into these systems, there's a lot of terminology, there's a lot of questions to get through, there's a lot of questions to answer. Training. One audit I read suggests the broker have another person check the filings. Great idea. It just seems like it's going to be difficult to get that kind of manpower. It's not like it'd be a tough sell. Let's take a class. SILA has a class coming up. WSIA has classes on surplus lines. The ASLI stands for Associate in Surplus Lines Insurance. There's Surplus Lines Law Group in the fall. It's a loose affiliation of attorneys and compliance people that meet and discuss issues, discuss common problems, those kind of things. And you can always outsource it. Next slide, Mr. Ocasic. What are surplus lines transactions? Why are they filed late? Well, many of the same problems. It's just human error, turnover, stress. There's a lot of confusion over the rules for counting days. So you're supposed to, a lot of states, you file 30, 60, 90 days, whatever it is, from the effective date. But a lot of them don't use effective date. They might say invoice date. It might say the date of the binder. It might say the date it was received. It might be the revenue recognition date. So you're going to have to get the counting system, that's consistent with the regulations when you make a calendaring system. Information received late from the broker teams. That's been the case everywhere I've ever worked. Zero reports are often forgotten because a zero report is the state wants a report that you didn't have any tax to report. And so it's not intuitive. Normally you file a tax return when you have something to report. And I'll just say many of the stakes in the audits are not necessarily the wrong calculation or late filings. It's all the other details. Class codes are difficult to come to grips with. Next slide, Mr. Ocasic. Okay, how to avoid late transaction filing? Well, automation would definitely help track these things. You need some type of calendaring system. Try to get the broker team to get the information to you quicker. You can file a binder. So a binder is a temporary document before the policy is issued. So you can file the binder, but in a lot of states, you're going to have to go back and then file the policy when the policy is issued. So if it's a 20-day deadline, you might have to file the binder and then go back and file policy information when you have it. If you can find a strategy to avoid that stress of annual filings, I don't know what it would be. It's going to depend on a particular broker. If you can somehow get more manpower, if you can get a vendor to help, if you can get uniform information out of the broker teams in the right format, that is an enormous help. Then you might have to get leadership to weigh in. Next slide, Mr. Ocasic. Why are there mistakes in diligent search documentation? Well, a lot of times the broker knows that they cannot place it admitted. They're just classes risk that the admitted companies won't take. It's more work, and if they placed it surplus lines, there's always a risk of somebody trying to steal it and place it in the admitted markets. The admitted markets have data, they price it aggressively, their forms are aggressive. And so the result is it just feels like an unnecessary process. It's hard to get institutional support to really get the attention focused on these.
I'm so sorry
Sometimes-
about this.
Sometimes the documents are not reviewed until the time of an audit. And states do audit, but a lot
Steve,
Steve, you got muted.
it muted you. Oh, you're still muted. There you go.
Huh. Well, somebody muted me. It wasn't me. Okay. How to avoid mistakes in the diligent search. Use some additional training, internal audits. Use the state forms, which are compliant, or have somebody check your forms if you made them yourself. Automate the process to get the correct form, store the correct form. There are vendors. An outsourced vendor can help. And some states have made this much more efficient. You log in, you certify that everything you could not place it admitted, and you went through the diligent search process, and that's it. That's all I have. Thank you for your time. And I'm turning it over to John.
Thanks, Steve. So I am John Mates, Senior State Relations Manager for WSIA. Can everybody hear me okay?
Yes.
Good. So WSIA is a little bit unique. We represent both wholesale brokers and carriers doing surplus lines business in the US. And one service we provide is kind of extensive compliance resources for our members, but these are also open to the public. And at the end, I'll show you all how to access those. I was hoping to kind of occupy the scared straight space, but I think Steve already did a pretty good job of that. So I'll do the map and graph portion of the webinar. David, do you mind? Yeah, there we go. So start you out with this. I pulled a bunch of data from all of the compliance resources that I'll show you how to access later. But here you can see how often states require either a report of surplus lines placement or an actual tax filing. And as Steve mentioned, those can be one and the same filing. They can be due on the same day but different, or they can be completely separate and due on separate dates. So I lumped these together just to kind of make my life easier, but they're ordered on kind of a spectrum of easy at the bottom to hard at the top. As you can see, there's a few states that require the prior stamping before approval. Down there all the way at the bottom, a few states only require annual filings. So you just have to do one filing a year, which is pretty convenient. We typically advocate for a quarterly filing system. We actually have some members of ours that say they prefer a rolling system, meaning that you have to file within 90 days of placing the policy. But for the most part, we advocate for a quarterly filing system because we think that really reduces mistakes, makes it easy for the broker. And frankly, if a state needs the revenue more often than quarterly, they probably have some bigger fish to fry. So that's what we advocate for. And typically when states are pursuing changes, they're happy to go to a quarterly filing system. It's just a matter of getting them on that system and getting them to want to think about making those changes. So to tell you the truth, I wanted to do actually a calendar to show all of you kind of how often there are filing deadlines throughout the United States. And it was taking me so long to get through all of the deadlines that I had to nix that slide. But effectively, if you're assuming a surplus lines broker is licensed in every state and places business in every single period, then they would be required to make a minimum of 292 filings every year. And that's if they only do one filing in each of those periods. It's just a lot of work. Again, that doesn't even include the prior approval states because that doesn't really fit into the way I was doing this calculation. But just wanted to give you an idea of how often you're required to do a surplus lines filing, whether it's a report or a tax, or maybe it's even a fire marshal tax, something like that. So let's move on to the next slide. Another thing that trips a lot of brokers up, especially new brokers, are zero premium reports. So 29 states still require some sort of zero premium report. In a lot of cases, there may be a quarterly report that is due where zero reports aren't required, but they are still required to file a single annual zero premium report. In others, they're required to file as many as 12, as many as monthly zero premium reports every year. So a zero premium report is essentially required when a licensed surplus lines broker is required to make a filing that they have conducted no business during a given period. And this is something, again, I'll show you how to access these resources later, but several states have substantial penalties if you don't comply with this. And it's something that trips up a lot of new brokers. And just wanted to give you one example. One of our members, they're probably on the call, but they shared some data with me recently. For about, I went through their numbers, and it looked like for the year of 2021, for about 500 licensees, there were a total of 3,300 zero premium filings that they had to make. That's 6.6 filings per licensee, which is just a lot of work to keep up with. So just wanted to give you an idea of that and remind everyone that zero premium reports are still out there, something we're working on all the time. And we're trying to reduce the amount of those, but they're still out there in a lot of states. Can we move on to the next slide? Yeah. Something that we focused on, this became a big focus during the pandemic. It's always been an issue of ours, but a lot of states still require either notarization, wet signature, or paper filings or checks to be mailed. So a lot of states actually waived some of these requirements during the pandemic, and most of them, I think, actually kept those waivers permanently. They found a way to make those innovations permanent. The NAIC Innovation and Technology Task Force actually took up this issue last year, and they requested comments from interested parties, basically asking what kind of things did states do during the pandemic that made their systems more efficient that we could make permanent. And we pointed out each of these states where notarization, wet signature, or paper filings are still required. You see the most common, 10 states still require some type of filing to be either mailed or payment to be submitted via paper check. And that's obviously problematic because a lot of folks weren't in the office and couldn't go to a post office during the pandemic, especially the early parts. 3 states still require filings to contain a wet signature, and 3 states still require filings to be notarized. So anyway, we pointed all this out to the NAIC Innovation and Technology Task Force. Beyond what states undertook voluntarily, I'm not sure if there's been any progress on this. If any of these states have taken additional steps to remedy these issues, I haven't seen it, but to tell you the truth, they may have done something without actually issuing a bulletin. So if you're aware of any of these states that have actually remedied these issues, please shoot me a note, and we're happy to update our data on this. Can I go to the next slide, please? Thanks, David. So broker fees are another thing that trip people up. And happy to report that we've actually made some progress on broker fees in the past year. So there are actually 5 states that require, that have a static cap on surplus lines broker fees. This is the fee that they're able to retain as part of, as recuperation for the work that they've done in placing this policy, not necessarily commission, which is a different thing. So anyway, in Maryland, up until this year, they had a $100 cap on personal lines, surplus lines broker fees, and a $250 cap on commercial lines, surplus lines broker fees. Senate Bill 572 became effective, I believe it was last month. No, I'm sorry, it was signed into law last month. But what that bill does is it raises those caps. For personal lines, the new cap will be $200, and the commercial lines cap will be $500 or 7%, whichever is greater. The bill also actually codifies what the Maryland Insurance Administration told us, which was that exempt commercial purchaser transactions are actually exempt entirely from these laws, so that you can charge any fee you need to on an exempt commercial purchaser, and that's now codified. Anyway, this is not, don't go out and do this tomorrow, but this bill actually becomes effective on October 1st. So we're happy to report that. So that leaves 4 other states that have caps on their policy fees, or at least static caps on their policy fees. Broker fee, policy fee, sometimes these are used synonymously. I try to use the word broker fee because the broker is typically the party that retains that money. Connecticut, Michigan, Montana, and New Jersey still have some sort of cap on their broker fee. In Michigan, their cap was raised actually recently. We worked on that bill as well. But there is still a cap on personal lines of $100 or 10%, whichever is fair. But what you're looking at on the map here actually has nothing to do with whether or not a fee is allowed. What this map shows is whether or not a fee is taxable. And this map is specifically detailing whether or not the broker fee is taxable. You may see some states here where the inspection fee is taxable, where the carrier fee is taxable, where any number of other fees may or may not be taxable. We try to detail those in the compliance chart I'll show you in a little bit. But here's a map of where those fees are not taxable and where they are. I think that's it for that slide. So we can move on to the next and kind of show you how to access some of these resources. First, I'll just show you how to navigate. Getting to our website is very simple, wsia.org. So you go to wsia.org. There is a ribbon in the middle of the screen, and that ribbon is titled Legislative Advocacy, Compliance, and PAC. Click on that link, and then it'll take you to a link where you'll see a menu of options on your right. And clicking on compliance resources will then take you to this page, which details all of our compliance resources. I'll walk you through a few of those. One of them is on affiliated groups. Our newest compliance resources on cancellation and non-renewal, actually. We also have one on carrier eligibility that details the requirements that a carrier needs to become eligible in each state. Of course, the NRRA set up uniform standards in that regard, but many states still have a voluntary list of a white list that has additional requirements that a carrier can apply to for eligibility. The next one is data security. There are probably better resources out there than ours, but for the purposes of our members, we needed to put together a data security chart that showed where states are implementing the NAIC Data Security Model Act. We also have a diligent search chart, which is our oldest chart, and actually we're working on trying to revamp that so that it's a little more coherent with our other charts at this point, but that all that information should still be accurate. So that's there for your resources. We also list all of the state disclosures that are required. We also have a export list chart that shows all of the lines that are, all of the states that have surplus lines export lists where you can export automatically without having to make a diligent search for certain lines. And then we detail all those lines of business that are exportable. Maybe our most popular is the tax filing and reporting procedures chart. And then finally, we have a chart on wholesale fees. And that is where you might find, you'll find the details about whether or not a wholesale fee is taxable. So all of these are free to the public and available. And I'm always taking feedback. If you ever see any errors, please let me know. Happy to work out any discrepancies that you might see. But feel free to utilize those resources. And yeah, I think that's about it. So I think that concludes my remarks. So why don't I pass it over to David Ocasic so we can hear how things go in Illinois.
Okay. Thank you, John. Coming over to me, I'm David Ocasic, the CEO of the Surplus Line Association of Illinois, about to celebrate my 31st anniversary. Is that possible? I don't think I look that old. I'm going to just cover a few more stumbling blocks that can get in your way when you are trying to stay on the right side of compliance. Some of these have been touched upon briefly earlier, but maybe we'll go into just a little bit more detail. The first is a little hard to bring up because it speaks not of love. The quality of your transactional filings and where some of the people in my position have some difficulties with that. And I did a brief survey of some of the other stamping office managers about some of the more common problems that they're having. I'm being asked if I started in the kindergarten program. I imagine that's a reference to the fact that I've been here for 31 years. Thank you very much. That was very kind of you to say. So quality of transaction filings. So reasons that this happens, and Stefan touched upon this. You all know we're in a fairly unprecedented times right now. First of all, due to the pandemic, and second of all, due to the just incredible surge in surplus line premiums that has been going on over the last few years. WSIA, that John Mates works for, just released a stamping office survey for the mid-year of 2007, and we're up some 38, 39%, I believe, overall.
32.
32? Okay, I think it was Illinois was up 38. 32% overall over prior year, and prior year was up substantially as well. So many more dollars are flowing through this market. We have all the problems you've heard about from the pandemic in terms of the big quit and other reasons that people are coming and going from their jobs. So we have enormous amount of turnover. I'm sure some of the people we're talking to right now are relatively new that you've come in. So we're hiring new people, we're turning jobs over, and the need for training is just enormous. And it shows up in the quality of the filings that are happening when there's this much volume of turnover internally, and then with third-party filers. I hate to use the term garbage in, garbage out. I don't mean to disparage the third-party filers, but as with anything, if you don't give those third-party filers good data, if you're not providing them with things in a timely basis, they cannot make them up out of thin air for you. So if you're using a third-party outsourced company to handle surplus line licensing or filing for you, you need to make sure that you are feeding them good information, that you're feeding them the information in a timely way. But you have to remember that those third-party filers are suffering from the same turnover and new hire issues that you are as well. And so their staff needs to constantly be training and getting updated on the changes in the law. Plus, there are changes in the laws and the procedures of every state all the time. I feel for the people who are having to handle and juggle multiple states and multiple states' rules all at once. We understand how difficult that is for you. As Steve said, though, there's nothing else to do but buckle down, use the resources that are available, and make sure you learn the various rules. Some of the things that stamping offices in particular complained about the most, the mistakes that are made, and one of them is a type of coverage. And this involves, making sure that your people are trained in some policy analysis. We actually have to do it here as well, and many other stamping offices have to do it as well. We're auditing some of the things that are filed electronically, and so we get the full policy sent into us, and we need to make sure that when it was entered, the right type of coverage was entered. And so we have to train our people here how to pour through the policy, how to recognize the coverage forms, how to look for the insuring wording, how to recognize which lines are being covered. Just because you found one doesn't mean there aren't more. You got to keep going, look through the entire policy. You find property, is it basic? Is it broad form? Is it special? Those all might cause different types of coverage. Many surplus line associations or stamping offices want to know the class, make sure you're, getting the right class of the insured when you're doing that filing. probably the number one thing I heard from the stamping offices is type of coverage and policy, doing the proper policy analysis so that that's submitted correctly. One of the other top ones was filing endorsements when there was no policy filed. This is another one that came up often. Many state stamping office systems will not let you file the endorsement if no policy was filed. Some will accept it, but you'll be tagged. Some will accept it if it's additional premium, but reject it if it's return premium, Illinois. Either way, it's just something to pay attention to because it's high on the list of problem transactions. Showing premium, taxes, and fees separately. Often this is required because they are treated separately. Fees, as John covered in his presentation, are taxable in some states, not taxable in other states. And other states have laws that require that you show the taxes and stamping fees separately if you're going to pass them on to the insured. So it's important that those get done where required. We did talk, I think this was Texas, talked about they also audit a percentage of the things that are filed electronically. They're sent in. We do as well. When those come in, often they come in, but they don't have the complete policy. They're missing some of the forms, some of the policy forms when we're doing the audit. Texas specifically talked about location schedules because sometimes they need to look at and treat separately locations that are out of state. So it kind of brings up, I'm talking about one state here, but you do need to know individual state oddities. It's just going to be part, if you're dealing in multiple states, you need to be trained on each individual state's oddities and you need to stay on top of them. As I said, they will change and you need to have a procedure in place to capture those changes, make sure they're recorded for your compliance staff and shared around so that everyone can know. Some states, they need you to report exempt premium separately from the taxable premium. Some states have something, I think Steve touched on this, a revenue recognition date. I believe that's Pennsylvania. So that their 1,600 monthly 1,600 forms add up to your annual surplus line submission. Reporting the producer license number versus the surplus line license number. Some states require you to record both and don't mix them up if they're different. Some states require one or the other and make sure you don't substitute one for the other when they do that. Another thing that John said that they have a wonderful resource for on that compliance resources page at wsia.org. Declinations and affidavit filings. Again, if you've seen one state, you've seen one state. They're all different in terms of what they require and whether or not it needs to be filed and at what level of detail. It's important that you know that what that level of detail is and that you comply with that. Some states, Illinois, for instance, don't require, you're required to do a declinations in most cases, except where there's certain exemptions, but you just keep it in your file. And if the department ever wants to audit you, it needs to be there. That's all that has to happen. Other states need a producer to file their declinations, and it has extensive information that has to match the information that's filed by the surplus line licensee. So the retail producer has to have a declination and affidavit filing and the surplus line licensee's information has to match that. So you need to pay attention to what level of detail is required and make sure that you're complying with that and that it's accurate. There were others, but those were the top ones. And hopefully that's the end of me beating up on you for all the things you do wrong, because there's, I'm sure, so many things you do right. We certainly know that here in Illinois. We get a lot of wonderful, complete and accurate transactional filings, and we know that that's what you're all striving for. But I figured I'd point out what those some of the top stumbling blocks in terms of the quality of those transactional filings. So moving on, We'll talk also about failure to file tax statements in a little more detail. Steve, I believe, touched on this, but it's an important topic. John talked about getting scared straight. I'm gonna go back into that arena for a moment here, and hopefully scare you straight on failure to file tax statements. As Steve mentioned, there are certainly substantial penalties involved when you fail to file, and they tend to increase over time. I'm going to give you one example. I don't want to badmouth any state individually, so I'm not going to say which state this is from. I'm not going to mention any names, but I will say that it starts with ill and it ends with annoy. Yes, Illinois, my state. I like that. I just came up with that. I feel pretty good about it. But I do have regulators that I have to work with. And so I'm going to erase that from the screen and just tell you that they start out when you fail to file a surplus line tax filing, the actual tax statement that usually there's a payment accompanying it. They start out with a late filing penalty. It's $400 or 10% of the tax due per month. So if you owe $0, it's still $400 per month, capped at $2,000. So that's basically, if you're 5 months late, you owe $2,000, even if you had zero tax due. In oldie times, right after the due date, they would send you out a penalty invoice for $400. And it was a wonderful reminder. Oh, I didn't file my surplus line taxes, and you'd get them in and you'd pay your $400 fine. They don't do that anymore. They wait until 5 months has passed and they send you a bill for $2,000. They got, I guess you could call it smart about trying to get as much revenue out of the brokerage community as possible. But again, that's if there's $0 due in tax. If there's tax penalty due, the penalty, if there's taxes due, rather, the late filing penalty is 10% of tax per month, capped at 50% of the tax due. So the late filing penalty is capped at either $2,000 or 50% of the tax due, whichever is greater. Whichever is greater. That means if you're a bigger broker, if you had a $300,000 tax bill and you were 5 months late in filing that, your late filing penalty would be $150,000. Illinois decided they're not going to stop there. That's just one category of penalty that they're going to assess. So it's a late filing fee plus they have a late payment fee, total separate thing, and it's in addition to the late filing fee. The late payment fee is 10% of the tax. That's $30,000. Director determines that it was willful, he can add another 50% of the tax. That's $150,000 more. Did they stop there? No. Late file, late pay, plus interest. Minimum of 12% per annum, prorated over 5 months, that would be another $15,000. Your original $300,000 tax bill has now turned, my friend, into $645,000. So I hope I'm scaring you straight a little bit with that slide. That is a nightmare scenario. One of the things we did here at the association was get them to put early time caps on some of this stuff. If you're only a week late or 2 weeks late or 3 weeks late, it's substantially less. So if you're going to be late in Illinois, be just a little late. Otherwise, this could be you. Moving on from late taxes, I want to talk a little bit about licensees coming and going. We talked about these unprecedented times and how things, premium dollars are flowing into this market. You know what? Brokers are flowing into this market as well. The state of Illinois went from 2,800 licensed surplus line brokers last July to 3,125 this July. That's 325 more licensees. That's an increase of 12% in 1 year in the number of licensees. Be sure you keep information up to date in NIPR or CIRCON or whatever other system is being used by the state for licenses, sometimes maybe even directly with the Department of Insurance or the stamping office as necessary. When you get new producers into your shop, don't wait, get those that information changed right away. Don't delay. Often delaying will result in a problem, especially if you're coming up against a tax filing deadline for that broker. Exiting producers, be nice. Either change their information for them because they don't usually know what they're doing, or at least give them very clear instructions about how they should go on and change their information so that the people who use these systems know that they're no longer affiliated with you and can direct tax information or other information to them in a timely manner so that they don't get that $645,000 fine that I showed on the previous slide. That is all I have. And I am ready at this point then to turn it over to Mr. Dan Marr. Dan, are you on?
I am ready to go. Thank you, David. And nice to participate in this event. And I think I want to start by saying that we have great sympathy for what it is to be in the compliance world in a system that has 50 different states and 50 different systems. We all have experience with that. I certainly had a lot of experience with that in my prior career, and it's not easy. There's some things that you can look at and say why there's great benefits for a state-by-state system. Perhaps consumer protection is at the top, but it makes for hard work to try to comply with 50 different state systems. And we'll talk before the program's over about things we're trying to do to make it easier. So one, I want to say you have our sympathies. I think the thing that I'd like to point out, the shops that David and I in particular run, we're here to help. We have all kinds of information on our websites, videos to help train people in specific areas related to the filing process and the laws of compliance with regard to excess and surplus lines. We will go to meetings with anybody who needs particular guidance and training. So we're there to help. But what we're not there to do, to David's point about some of the sloppiness in filings, if we do have brokers that are just throwing things into an affidavit form or electronic affidavit form, expecting Elaine's going to fix everything. So it doesn't matter what we put in, just send it to Elaine and they'll fix it. And we do fix and hold hands and walk through a lot of these transactions with the brokers. But when we see that there's no effort whatsoever on the part of the producer to get it right, and they think we're just going to repair it for them, that's when the transactions start to get suspended, and that's when the regulators take even a closer look at what's going on. And I'll tell you something: Illinois knows nothing about fining people. All right, you want to know how to fine people? Just watch New York, right? Because recently I've seen fines for $100,000 and $500,000, mostly related to late filings. 100,000 and $500,000. Sometimes they impose them as penalties, so they're not published, so not all the broker community is familiar with what New York is doing. But New York, during the Cuomo years, we went from aggregate fines in the state through the various regulators under the Department of Financial Services to $4 billion a year, as much as $4 billion a year in total fines. Thank God there was more on the banking side, because I guess they figured the bankers make more money, can afford higher fines. But there was no free lunch on the insurance side. So what do you really need? And I'm going to start with something I've said to brokers for all the years I've been at Elane, not quite as many as Dave has been, but I didn't start when I was in nursery school. So I think it's really a top-down effort. That's what you have to start with, top-down. You need a commitment. Brokers don't make money filing and complying, and sometimes there's just not enough focus. And falling behind is where it starts. And if you fall behind, you're probably going to stay behind. So it's really they have to have a top-down commitment to doing things timely and training the people and putting enough resources on the compliance side, because there are 50 state systems, and if you're a broker that's 50 statewide, then there's just so much you have to do, and you have to dedicate the right resources in order to be able to comply. So now I'm going to move to a couple of things on my slides here. Keeping licensing straight. A couple of things on that. In New York, we call a P&C license is considered an agent license. So a retail broker, somebody who's licensed as a broker, can go to a wholesale excess line broker to place a risk in the non-admitted market. But somebody with a P&C license is somebody who's been appointed by a particular license carrier, one or more license carriers, to bind business on behalf of that carrier. They are not permitted to bring a risk to the excess line market through a wholesale excess line broker. Another big issue in New York, and different states have different versions of this. We will see some transactions submitted by an individual licensee, and yet their letterhead, their stationery, often shows that they're part of an entity, either a corporation, LLC, or a partnership. If you're doing business as a partnership, an LLC, or a corporation, the entity has to have the license. You can't, that entity will be responsible, if you will. They're collecting the premiums and putting them in a premium account, fiduciary account under that entity. So when you say the individual is placing the business and they're the licensee, the entity technically shouldn't be holding that premium trust account and shouldn't be collecting the commission. So if it's an entity business, it's got to be an entity license. If it's an individual that's running a proprietary or a sole proprietorship, that's fine. But the crossover in licensing becomes an issue. So speaking of the crossing over of licensing, let's go to the next slide, okay, David? So there's a bill that passed during the Obama administration called NARAB 2. It was heavily supported by the industry. The purpose of NARAB 2 is to create a not-for-profit entity under the laws of Washington, D.C. The board of directors has to be appointed by the president. Once it's up and running, the concept is if you join NARAB as a member, you get your own home state licenses. And then you can go to NARAB and say, here's the 30, 40, 150 other licenses that we need from other states. And NARAB essentially is the clearinghouse for all your non-resident licensing needs. We supported it because we see that as a great step forward in terms of reform, uniformity, and helpfulness in terms of saving brokers money. Unfortunately, that appointment by the president, Obama did appoint a good number of the board members. I don't think he appointed all that he had to appoint, but those board members have to go through a FBI background check and then have to be confirmed by the Senate, like a federal judge. And what happened is the clock ran out during the Obama administration. During the Trump administration, nobody was appointed, and as of yet, nobody has been appointed during the Biden administration. This is, I think, one of the most reform-oriented bills to help the producer community in the United States. So hopefully, and I had a conversation as recently as last Friday with one of the federal officials at Treasury, asking them to move this along. The next slide, David. So late transaction filing. I think David hit on this, but at Elaney in New York, if you file late, which is more than 45 days after the transaction was placed, or inception date of the transaction, you will be charged an additional $25 by Elaney. If you file a transaction which is so defective that Elaney can't process it, it's called tags in many states. In New York, we call it suspense. That's also a $25 fee. But the point there is you're not getting out from under the possibility that the department will also fine you. And as of recent times, as I said, we have at least two examples, one $100,000 penalty and the second a $500,000 penalty paid by members. And I can tell you that it's not going to end with those two, because because of our experience with the department and things that they request, or the nature of some of our communications are clearly pursuing other brokers for late filings. So not to tell you Illinois is not important, but I think if you want to make sure that your filing's on time, you should do it in New York first. Sorry, Dave. In New York and other states, and I'll use New York as an example because New York probably has the most significant list of types of coverage. While generally most property and casualty coverages can be placed in an unadmitted market, there are a number of types of coverage beyond what other states do not permit, such as, a lot of states do not permit any kind of life, accident, and health, or workers' comp coverage. But New York has an extensive list, which I won't go into. But the point is, when New York's the home state, you need to be careful, make sure New York will allow you to process a particular type of coverage. And that's something we have on our website, so I won't go into too much detail here. I'll add one thing. New York does not like unaffiliated group policies. Of course, there's some exceptions like purchasing groups, but on the property side, there are no exceptions. So that's something that should be kept in mind. And with that, I think we move to our big picture, wrapping it up. So Steve, back to you.
Thank you. In a few minutes, we're going to talk about things that we might be able to do, ideas for trying to improve this. I mean, obviously, uniformity. There was an interstate compact at one point trying to get them to have uniform systems. So let's start with John, and we probably only have about 30 seconds a piece or a minute a piece. Talk about what would be ideas for trying to streamline the process.
Yeah, well, WSIA has, kind of codified our uniformity and regulatory principles. You can find those on our website, adjacent to the compliance resources, actually. And, that's something we're constantly working on. We invest a lot of money and time into, approaching each state and trying to get them to work towards solutions that are uniform. Sometimes uniformity isn't actually always the best solution. Better is better if you can find a better process for diligent search. And so we go that way too. But for the most part, we kind of know what works and it's out there. And getting states on the same page makes it easier for brokers, allows more entrance into the marketplace, and that's good for everybody. So yeah, that's where we're focusing at WSA.
Great. David, you have thoughts on streamlining the process?
Other than uniformity, more uniformity between the states, I would say, if I had to wrap it up, I would go back to the idea of make sure you develop a good, robust, bulletproof in-house tracking system for how to comply with the various state rules. Make sure it has some sort of integrated calendar that will give you pop-up reminders of when things are due, and keep that up to date.
Great. Dan, you have thoughts?
Yes, well, we have a bill right now that's passed both houses of the New York State Legislature that if it gets signed by the governor, and we're begging, will eliminate 4 of the declination data requirements for each declination, which means 12 less data points reported on every transaction. We estimate that means 2,750,000 less pieces of data to be reported to Eleni annually based on current transaction volume. We think, streamlining the process any way we can. I think, congratulations to David. He got a bill passed in Illinois that did, among other things, exempt certain wholesale transactions for commercial risk where the retailer and wholesaler were unaffiliated. That's something that we've been pushing for in New York. We'd love to get it done, but it's just working together with the other states and seeing what we can do to narrowly target what needs to be reported so that there's clear compliance, but we're not overburdening the brokers with the reporting requirements.
And I'll just add this, the differences from state to state are significant. Even the definition of premium is not the same. So some of them, there's a lot of other elements that go into premium, and you have to look at that. So when the group worked on Interstate Compact years ago, I think they said uniform definitions, uniform premium report, uniform reporting deadlines. And so it doesn't have to be completely reinventing the wheel. It just has to be getting a few uniform points would definitely streamline things. And a lot of those are kind of outlined, as John mentioned, on that site. And that is all I have. I think we're done. Julia, did you want to say goodbye to the group?
I did. I want to thank, first of all and foremost, I want to thank all of you for joining us for this webinar. All of you are industry leaders, and you have been for years, and you have implemented industry changes across the board over the years. And the work that you do in the non-admitted market and the surplus lines market has been amazing. So thank you very much. I want all of you to know that there are training opportunities with not only the WSIA, but also through SILA. We are going to be having 2 pre-conference surplus line classes that we had, except for the past 2 years, they've been online. We are going back to in-person on surplus line fundamentals and an advanced class. And for those of you that are familiar, we will be having surplus lines Jeopardy. The second thing is I'll reach out to the states. They're there to help you. The stamping offices are there to help you. So if you have any questions, reach out to them. I want to also let you know and remind you that the SILA Foundation was able to bring you this webinar free of charge through donations and through our sponsors, the help of our sponsors. So if you can donate, great. If not, at least let other people know, send them the invitations. This particular webinar will be in the SILA Foundation library that you can access, and you'll be given a link where you can access the PowerPoint as well. And I want to thank all of you for joining us. Thank you for participating in this webinar. We're so grateful that you joined us today. Have a great afternoon. And with that, I will say goodbye to everybody. Thank you very much.
Take care, everyone.
Thanks, guys. Thanks, everyone.
Thank you, Julia.
Thank you.
Bye.
Bye-bye.